noise is that? Yeah.
Been a ton of news lately about this flood of foreclosures coming, the housing market, housing bubble happening. Like I said, we're having a conversation this weekend. People talking about, they're going to wait till this time next year because they're hearing on the news that there's going to be a bunch of foreclosures and possibly can start buying houses a lot cheaper and things of that nature. So Chris and I want to share 3 slides with you to basically talk about the economics of foreclosures and what really has to happen in the economy for a flood of foreclosures to hit the market. So, so first, I'll take this first slide. We've talked about this slide before. This comes from the National Association of Realtors. This is your annual average month supply from 1999 to 2021, a span of 20 years. And you can see our 07, 08, 09, and 10, when we did have our housing bubble and our housing crash, you can look at the month supply that we had. And I believe this would be 8.9 million, 10.4 million, 8.8 million, 9.4 million homes on the ground for sale.
Yep.
And after you see in 2010, that number significantly dropped. You get to the COVID years of 2020 and 2021. Your inventory was at 3.1 and 2.3. The dotted line there is going to basically kind of show a balanced market. So where inventory is meeting what buyers are needing. And if you come and look out to today, that is pretty balanced. So there's just about as many homes on the market as people that are looking for it. That's why things are slowing down. Houses are staying on the market longer. We're going to look at that data in a little bit. Pricing is leveling out. Not crashing, but leveling out. So what would you add to this, Chris?
No, I mean, that's you hit the nail right on the head. In a normal market, right? Like we've seen from time to time over the last, even 15, 20 years that I've been in the business, homes take 30 to 45 days to sell, right? As long as they're priced appropriately, right? So that means that the listing agent that you're talking to, if you're talking to the Oldham team, you don't have to worry about them, fluffing your numbers. They're going to tell you, hey, this is what you need to list for. It's up to you as the seller, whether you want to take that advice or list under or list over, right? So ultimately, if you are listing appropriately at what the market is saying, your home is worth, then your home will sell in 30 days, right? It'll go under contract in 30 days. What we're starting to see and what we've been seeing here locally in the market is everyone still thinks they can, put their home on the market over what the market is saying it's worth. And then they're still thinking that they're going to have 4, 5, 10, 15, however many offers over list, right? And that's just not the case. So when you start to see this drop in price, it's because the price that they started off with was too high to begin with.
Yeah.
So again, this is not the time, sellers, if you are watching and listening, this is not the time to be greedy, because if you then have your home on the market for 60 days and you've had to reduce your price, 3, 4, 5 times because you're not taking the advice of the professionals, people are going to start to think, well, then what's wrong with this house, right?
Yeah.
There's got to be a reason, and it could be a perfectly good house, right? Yeah. But because you wanted to be stubborn and not take the advice of the professionals, it's going to take longer, and then you're probably going to end up having to take a lot less than you would have if you would have started off pricing it appropriately.
All right, well, let's look at our second slide. Maybe
technology,
Well, it was going to.
There we go. Oh, automatically.
I'll let you talk about lending standards and what's happened since the housing bubble and how that is going to help.
Yes.
Alleviate this foreclosure.
Yeah, man, absolutely. Yeah, a combination of things of again, why we won't see the housing bubble that we did back in 2007, 2008. Now, leading up to that, right, there was these acronyms that we like to use in the real estate industry and mortgage industry. NINA, CISA, right? That's a no income, no asset loan. So if you had a 720 credit score, which at the time was, a really good credit score, you could either not put any income or assets on the application, or you could state your income or assets on the application, assuming you just had the credit score, right? So that's all it would take. Now, ultimately, you still had to have to, come to closing with the funds that are needed, right? If you need 50 grand at closing, you can't show up without it and still get the house. You had to show up with that money. But there was tons of different ways that it could have come, right? So it could have come from, you offered 50 grand over list price and the seller's basically kicking the 50,000 towards your down payment and closing costs, or, the real estate agents were, kicking in at that time. There was a lot of crazy stuff going on, right? That is not the case anymore, right? And even so there's another program going back, a product that was available that was called a pay option arm, right? So that pay option arm would give you the ability to make a 30-year mortgage payment, make a 15-year mortgage payment, make a 5-year arm mortgage payment, or the one that got a lot of people in trouble was a negative amortization payment. So, or I'm sorry, there was another one, interest only, right? So interest only, you're at least staying level, right? If you're just paying the interest, your principal balance isn't going down, but at least your principal balance is not going up, right? The negative amortization option, you'd pay less than interest, right? So then you're adding money to your principal balance. Now, if values are going up significantly, right? I'm trying to keep if your values are here and then you're adding to your balance and you sell right here, then you're probably still okay, right? If you're adding this much and your principal balance has now gone back up, then you're, in most cases, you're underwater, which is what we saw, back in 2007, 2008, 2009, right? That is not happening today. There was a thing that was rolled out in 2014. Obviously things got tighter, right, since 2008, 2009, but in 2014 the QM acronym came out, which stands for qualified mortgage, and that is holding banks and lenders to a higher standard of, hey, you have to confirm a consumer's ability to repay the loan, right? ATR, ability to repay, and if you can't do that, and they end up having to foreclose on it, the lender, the bank could be liable, right? So again, all of these crazy loan programs that were, interest only, negative amortization, those aren't available anymore, right? So you can't, at this point, you can't pay less than interest only, because there are still some interest only programs that are out there. Because again, interest only is not bad as long as it's used appropriately, but there definitely aren't negative amortization type programs. So yeah, so the thought that we're going to have a ton of foreclosures due to loan programs, that's just not going to happen, because those programs are not being issued, and they haven't been for a long time.
And as we look at this chart, we obviously had a tightening up of mortgage credit availability from 06, 07 to 08, a significant, obviously, tightening of lending standards. And it pretty much ticked along the same way. It looks like they started loosening up, loaning more up until about the pandemic. And, I remember the day after the pandemic, we had people that qualified the week before that didn't qualify anymore just because of new lending standards that were put in place.
Yeah, specifically in the self-employment realm, right? Because again, if you're self-employed and your business and you had a retail business, right? If your local government said, hey, you can't go to work because you're non-essential, then you're not making any money, right? And ultimately, the lenders couldn't verify your ability to repay, because no one knew what was going to happen in 6 months, 12 months, 2 years, right? So yeah, it loosened up, and then right after COVID, it definitely tightened up a little bit again, for sure.
Yeah, and it hasn't, obviously, as of today and around now, it hasn't got back up to those that higher level that we saw in 19. So all right, let's move on to the last slide. This is the staff U.S. foreclosure activity by year. We are halfway through 2022, so it's a perfect time to look at this. So we were talking about this yesterday. I'll let you take this one, Chris.
No, I mean, looking at the numbers post, and again, what our frame of reference, right, is what happened, the Great Recession, right, of 2008, 2009. And there was, 1.6 million foreclosure filings essentially post the crash, the housing crash. And again, we can clearly see this stair stepping downward, right, to where 2022 we're at a tenth of what it was back in 2010, right? And one of what's crazy is the news, actually the media got this one correct. They said, hey, foreclosures are up 100,000 of what they were last year. And although that is true, the context is not there, right? In 2020, 2021, essentially, lenders weren't allowed to foreclose due to the pandemic, right? So there was some assistance there that was provided on both fronts, right? So customers, if they couldn't make their payment, if they couldn't make their payments, they were having to, they would call their lender, and the lender would put them on a forbearance or something like that. And then ultimately, the government was kicking out money to try to help with relief and all that kind of stuff. So when you go from a level of where essentially foreclosures were almost not allowed, right, in 2021, to where they're at now, and they've gone up 100,000. Yes, they are up significantly. But if we look at 2020 and 2022, we're essentially at similar levels, right? And then if we look at pre-COVID, right, pre-pandemic, even 2015, that's 600,000.
Yeah, we're
I mean, we're
yeah,
still, we're
way lower
way
than
lower than that.
so.
So the numbers aren't there to support this influx in foreclosures that everyone keeps talking about.
Well, in the conversations I was having, I was trying to explain that, since 2014, 15, you see them start dropping and going down. And that's because people were starting to build equity in their homes. And so when you have equity in your home, you can either A, sell it and
Right.
make some money, or B, you can refinance or do something, pull equity out to get you out of situations. So right now people have, I forgot what the number was. I saw it yesterday.
Yeah,
I thought,
we talked about, I think it's 42%. 42,
yeah,
it's 42 or 47% equity. That's national average, right? So most people that own homes in the US have over 40%.
yes. So that's, probably the biggest sign that we're not going to have this flood of foreclosures, because if people do lose their job or they get in trouble, they're going to have options that they didn't have in 2010, because in 2010, when they wanted to sell their house, there was 5 million or whatever it was, 10 million other ones sitting on the ground, waiting. And there's just not that many homes sitting now. So
Right.
anyway, hopefully that'll put a few people's mind at ease.
For sure.
Whenever you lose your job, don't think that you automatically have to lose your house.
Right.
You know, contact somebody, and
Yeah.
I think we talked. I mentioned the story in an earlier one of our reports. Was I know somebody that moved into a house right when the COVID hit. They bought the house, never made a payment on it for a year and a half. And before the bank foreclosed on it, sold it for $30,000 profit, and
Yeah.
then never made a payment. So that's just an example of, and that was a 1 year of equity. So these people that have been in the home since 2013, they have a lot of equity. So anyway,
Yeah, for sure. Yeah, and again, if you find yourself in that situation, call somebody, right? Don't stick your head in the sand and just say, hey, I'm gonna ride it on until the bank, takes it from me. That is
yeah.
definitely